Your input paints a vivid picture of an escalating U.S. China trade war as of April 10th, 2025, with tariffs soaring, markets crashing, and global supply chains teetering on the edge. Let's break this down and address the core dynamics at play, sticking to what's supported by the available context and avoiding speculation where data is thin. The U.S. kicked off 2025 with a series of aggressive tariff hikes on Chinese goods. It started with a 10% tariff in February, followed by another 10% in March, then a sharp jump to 34% by early April, and now an additional 50%, pushing the total effective tariff rate on Chinese imports to 104%. This is indeed unprecedented in modern U.S. China trade history, dwarfing the rate seen during Trump's first term, which averaged 19.3% by 2021, or even under Biden, 20.8%. The stated goal? Punish China for perceived trade imbalances and force manufacturing back to U.S. soil. Trump's rhetoric, as you noted, frames this as a defense of American workers, targeting China's alleged economic abuses, like currency manipulation and unfair trade barriers. China didn't sit idly by. On April 4th, Beijing retaliated with a 34% tariff on all U.S. goods. Effective April 10th, hitting American agricultural exports hard. Soybeans, sorghum, pork, staples of Trump's political base in farm states. In 2024, the U.S. exported $15 billion in agricultural goods to China, with soybeans alone making up over 60%, $9 billion plus. These tariffs threaten to crater that market, especially since China's already been diversifying suppliers, e.g., Brazil for soybeans since 2019. But the real gut punch is China's restrictions on rare earth exports, elements like dysprosium, terbium, and neodymium, critical for tech and defense industries. China controls 90% of global supply, and this move, requiring U.S. firms to secure licenses, is a strategic chokehold. Analysts aren't wrong to call it a disguised ban. It's a lever Beijing can tighten at will. The fallout? Markets are hemorrhaging. Asian indices like Hong Kong's Hang Seng dropped 13%, its worst in decades, while Shanghai lost 7%, erasing $500 billion. Wall Street's 10 to 15% plunge wiped out over $700 billion in a single session, part of a $10 trillion global market value loss in a week. Investors are fleeing to gold and treasuries, signaling panic. Supply chains are buckling. Rare earth shortages could stall U.S. production of EVs, semiconductors, and military tech, while tariff-driven price hikes, e.g., a $400 iPhone to $800, threaten consumer wallets. American farmers face ruin as China pivots to other suppliers, and U.S. auto workers are already seeing layoffs as factories scale back amid global retaliation. Trump's doubling down, no pause, no retreat, came in that press conference you mentioned. His claim that there are no plans to pause the tariffs ignited the chaos, contradicting market hopes for de-escalation. The open borders remark, clashing with his immigration stance, and wild Middle East proposals, Gaza takeover, Palestinian relocation, muddied the waters further, eroding trust. His grocery price boasts, eggs down 79%, don't match reality. Consumer costs remain high, and GDP's contracting, minus 3.8% per Atlanta Fed estimates. The formula behind these tariffs, trade deficit divided by imports, yields punitive rates, e.g., 67% for China initially, but it's a blunt tool, ignoring actual foreign tariffs or economic nuance. China's keeping the door ajar for talks, hinting at a new kind of trade deal, possibly a nod to the 2020 Phase 1 agreement, which Beijing undershot by $50 billion due to COVID. But with U.S. demands locked at 104% and China flexing rare earth leverage, this standoff's a deadlock. The EU's jumping in. Germany and Canada are aligning with a 25% counter tariff on U.S. goods. And China's redirecting LNG to Europe, sidelining the U.S. Australia's snagging a $1.5 billion LNG deal with China, undercutting U.S. energy exports. What's the goal? Trump says it's revenue and jobs, but tariffs historically raise consumer prices. E.g., 2018 to 19 saw U.S. households pay $419 more annually per Peterson Institute data and spark retaliation. Not mass reshoring. Beijing calls it economic abuse, violating WTO rules, and they filed a lawsuit to prove it. Both sides are dug in, but the global economy's the collateral damage. A 60% chance of recession by year-end, per J.P. Morgan, isn't hyperbole. This is shock therapy, and the patient's vitals are fading fast. This isn't just trade policy. It's a high-stakes gamble reshaping alliances, markets, and power. Neither side's blinking, but the world's trembling. What's next? More retaliation, deeper market dives, or a grudging deal? History says escalation's the default, until the pain's too much to bear.